You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/The Options Insider, or via questions at theoptionsinsider.com. The Options Insider Radio Network is sponsored by Fidelity Investments. Fidelity's Option Trade Builder tool can help you confidently build an options trade in 3 simple steps. Just choose a strategy, select a contract, and then review the benefits and risks of the trade. Learn more about Option Trade Builder at fidelity.com/options. Options trading entails significant risk and is not appropriate for all investors. Certain complex option strategies carry additional risk. Before trading options, contact Fidelity Investments by calling 800-544-5115 to receive a copy of the characteristics and risks of standardized options. Fidelity Brokerage Services, LLC, member NYSE SIPC.
Join us now for the expert source for inside information on the options markets. It's time for Options Insider Radio with your host, Mark Longo.
Welcome back to Options Insider Radio, the interview program here on the old network where we welcome on guests from throughout the world of options and derivatives and proceed to pick their brains for the benefit of you, the listener. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting, at least we hope so, Options Insider Radio Network. If I sound a little bit different, because I'm not coming to you from our studio in Chicago. No, I'm coming to you from the Securities Traders Association Annual Market Structure Conference here in scenic and sunny Washington, D.C. And as always, when we head down to these conferences, we like to bring you a slew of interesting guests from throughout the world of derivatives. And joining me here today on the program is a newcomer to the show and indeed to the network. She is Arianne Criqui, the Senior Vice President and Head of Derivatives and Global Client Services over there at the Cboe. Arianne, welcome to the program.
Thanks so much for having me. I appreciate it.
Arianne, as we are wont to do with all of our first-timers here, why don't you go ahead and give our audience a little bit of an overview of your background and how you found your way to the Cboe.
Great. Thank you. I have been in the business or been in Wall Street since 2000, so that's now 19 years. Most of that time before joining Cboe has been on a sell-side desk. I spent it at 2 large institutional banks. And the majority of that time, starting probably back since 2005, has been in equity derivatives. In that capacity, I spent time both doing high-touch sales trading, idea generation for not only listed options, I would also call OTCs, exotics, plain vanilla swaps as it pertains to the derivative space. But through and through, over the last 15 years, I've been intimately involved in strictly listed options and the market structure around it. As I evolved in my career, it evolved not only from a traditional high-touch position, where you use voice and block, as well as liquidity providing, over into the electronic space, which would allow me to kind of evolve in terms of the nuances of options market structure, order routing, order placement, algorithmic offerings, as well as systematic trading that tended to evolve as the business, not only the equity business, but also the options business started to become more and more electronified. Prior to joining Cboe, I spent a significant amount of time, probably the last 3 or 4 years, on Cboe's advisory board. So that became how I started my relationship with Cboe.
That's what lured you to the dark side.
It sure did. I said no for a period of time. No, I'm kidding. I think at some point I knew that I would move over into the exchange space. I didn't know when that might have been. And the opportunity presented itself about a year ago around this time.
And what was it that attracted you to the exchange? Obviously, you're on the board, so you had some experience. Was it the products? What made you make the leap from Goldman over there to the Cboe?
Yeah, no, I think Cboe is known as just had a wealth of proprietary, very successful proprietary products that I'd always had used, had always traded, and the respect and obviously leadership position within the U.S. listed option marketplace. I think also you're talking about a team, an executive management team, as well as a product and product development team that was best on the street. Those types of things, in addition to the culture, really made a lot of sense to me, as well as the opportunity to take the business and the opportunity that was presented in front of me, as well as leading the options business and the distribution effort, really was a home run in terms of the opportunity and the next step in my career.
And you're still based in New York, correct?
I am in New York.
Are you enjoying our fair city of Chicago? I imagine you're spending quite a bit of time back and forth these days.
Yeah, I think I do make the trip to Chicago every other week. I think I've always enjoyed Chicago. I obviously have an office or colleagues in Europe as well as, in London, as well as over in Asia. Maybe not visiting Asia so much right now, but over to London, all of those offices have been great. But the majority of my time, knowing that our floor and a lot of my colleagues are in Chicago, I'm there every other week. That being said, I know that you and I talked prior to me sitting down here with regards to an office move and a floor move. We're quite excited about that, and the new facility is going to be superior. I won't necessarily comment on what the current facility looks like, but we're excited for the move.
Well, let's mention that because I obviously spent a lot of time back on that trading floor. I'm pretty familiar with the SPX pit and the pit committee that runs it. They're very, shall we say, they like things a certain way. So that must have been interesting for you. Walk us through that process. What was it like getting everyone to sign on, and also just dealing with the notion of moving what has been a historic venue, historic trading crowd, and creating a new area and all that goes with it?
Yeah, no, I think you're asking a great question. Not only did you have to think about the particulars of the exact specifications physically, you also have to look about trading and the emotional connection and spots and particulars.
People still have physical spots. It sounds antiquated to say in 2019, but they still have physical spots. They're very tied to, I'd imagine.
Yeah, and the sensitivities and the communication had to be spot on and as aggressive as we possibly could be to make sure that we're providing comfort to these individuals that provide some of the best liquidity globally into this product. So getting that right was utmost importance, and I think we probably spent more time negotiating and figuring out those specifications rather than the lease and the potential move for the other office or the main office for the business component of it. There was much more scrutiny and focus and communication around the logistics primarily of that S&P pit. And we feel pretty strongly about making that is going to persist, as well as to the exact specification as required by our members.
Well, we've seen a lot of exchange groups. It's ironic, 2017 till now has kind of been the year of almost the rebirth of the trading floor. We saw NASDAQ put a lot of effort into moving and upgrading Philly. Obviously, NYSE put a lot with their old Pecos facility. Even Box has a trading floor. So anything interesting, any new bells and whistles you guys are adding to the new facility to make it, shall we say, ready for the 21st century?
Yeah, I think that on Monday, we obviously have the migration of our final medallion, which is our Cboe, our C1 medallion, over to the new BATS technology. And quite frankly, I think we all might be a little bit happy not having to always talk about that. But it
has been, 2-3 years now, and it's been a lingering issue over your heads. I have to imagine that's probably a great weight to be lifted, hopefully.
Fortunately, I came in the 9th inning,
yes.
So a lot of it being evolved and being completed, but it not only frees resources from our perspective, but also our customers' perspective, so the ability to release technology a lot quicker, to be able to be in the forefront of maybe what we view as enhanced floor trading tools, our PAR portals that you probably remember, handhelds and things like that, will be much more sophisticated, faster, the ability to go to pit, and the inability to maybe have dropped connections and things like that will not happen anymore. So a lot of it is the improvement of technology will also enhance the profitability and the execution quality, not only in the matching engine, but also within the floor and the floor technology.
And is the primary portion of the space going to be VIX and SPX? What else are you migrating over there and squeezing in there?
Yeah, I think there's several other pits that will be maintained, but obviously those are the two largest ones where we're spending the most amount of time and need the most amount of space. The other ones are combined as it pertains to like our XSP and ETF pits are together, a RUT pit as well. Those will all be maintained in smaller fashion, but making sure that what you saw before is also going to persist going forward because we're committed to continue to have the floor and the floor presence because the liquidity and the amount of information and the execution quality that goes up in that pit is outstanding, and we believe it's an important part of the liquidity and the listed options market.
So when you're not dealing with the logistics of migrating floors, head of derivatives is a pretty broad purview at a derivatives exchange. What is it that you spend the bulk of your days focusing on these days?
Yeah, no, I think Cboe is uniquely positioned. I think this is one of the reasons why I joined was just we have a very unique set of proprietary products. We have the ability, and I think you've heard our executive team as well as some of my colleagues continue to talk about what we view as our organic growth strategy. The ability for us that we think that we're only in the middle innings of growth in S&P and VIX. They're a well-known product, but we do think that focusing not only on the distribution strategy globally, as well as the product enhancements is critical to the business, and we think that we're pivoting in that direction right now. And what am I spending my time on, you ask, is twofold. We've made steps to thought about getting to know our customers better. How are we going to enhance our distribution model? We have a great team in place, but maybe limited focus in years past on the asset managers, the end users, the pensions, the insurance companies, even the RIA community, where maybe we had limited resources. We've enhanced our team. We've started hiring more people that are focused specifically on those distribution efforts globally, and they're starting to come up with their visions and how we're going to be actually penetrating that space a lot. Those investors more and more, because we do think that there's more assets and capital to be deployed into the U.S. listed options marketplace, whether that's educational or even just content-driven, or the ability for us to have an enhanced technology platform for people to start to trade more and more of our organic product. And then you flip that, what's the other side of my day like? How are we enhancing our existing product? We're spending a lot of time speaking to newer products, which is like our XSP product listing on multiple different venues, focusing on the retail customer being listed on our EdgeX platform, or XSP. We're seeing a significant amount of interest. That's obviously the SPY competitor on C1. So that growth has been really good this year, and we think that we can continue to see that grow. The other part is our iBox futures, where we're starting to see more and more interest. That, again, is our credit future. So there's two sides of it. You have the knowing the customer component of it and doing more with them, and then making sure we have the product to offer them because of what we're learning from that end customer.
That's not surprising to hear that you're focusing on the RIAs and the asset managers. A lot of people we interact with in the space, that's been a growing focus for them for a number of years. We've actually had a program for a number of years now on the network called the Advisor's Option that speaks directly to that RIA and asset manager crowd, because so many firms, you're right, want to reach out to them because they are in many ways untapped potential from a listed options perspective. They're an interesting audience because on one hand, they're financially sophisticated. On the other hand, when it comes to options, maybe not so much. So you have to kind of lead them to the water a little bit and explain almost in the way you would a basic retail client what a call and what a put is. But once they learn what a covered call is, they can do 10,000 at a time. So it's an interesting hybrid audience, and I'm glad to hear that you guys over there at Cboe are reaching out to them these days. We're here in D.C. What is it that brings you down? Obviously, aside from speaking to me, what is it that brings you here to D.C. this week?
This is the conference to come to as it pertains to market structure. I like to call myself a little bit of a nerd about it, and being able to be with those who think thoughtfully about the evolution of the marketplace, not only primarily in equities, so it's an equity-based conference, but in options, it tends to follow the lead, or we lead in options, or equity leads in another type of market structure change. You want to be on the forefront of that, and this is the conference to be at that. Whether that's, we're going to hear lots of conversations around asymmetric speed bumps, or we're going to hear about retail priority. Retail priority tends to be something in the option space that had already existed. Now we're starting to see it evolve into the equity marketplace, whereas now we're going to see an asymmetric or a speed bump that might exist in futures, and we're seeing it evolve into equities. Does it evolve into options? I want to be thoughtful and understanding of how the impact of those changes can structurally maybe change what my bread and butter, my major is, which is options or derivatives. So hearing from experts in other asset classes is important to the growth of not only the business, but Cboe in general.
Are you a fan of speed bumps? I mean, we know the recent news out of IEX maybe isn't too favorable to that side of the space right now.
I enjoy having the conversation amongst multiple members and multiple liquidity providers as well as multiple participants in the marketplace. I just hosted a panel at SIFMA Options where I was the moderator and asked the question, and we had a very probably 20-minute heated debate on those who are in favor and those who are against it. I think that, there's 16 exchanges within the option marketplace. One of the participants said, why doesn't someone go and try it out and put one out there? A valid point nonetheless. I think that there's always the camp of those who are investing in their technology and maybe not investing in their technology as much. They tend to be the for versus the against types of categories. I think what's different in the option marketplace than in the equity marketplace is that there's a finite amount of liquidity providers. We appreciate and award those who are new entrants, so the ability to protect those liquidity providers is something we should consider, whether that's in a speed bump or a technology fashion, or it's other means of making sure that we're incentivizing liquidity providers to continue to provide strong quotes on screens to have the best execution quality for customers. Whether or not I'm leaning one way or the other, too early to tell, but definitely one that we're want to make sure that we're evaluating all sides of the equation to make sure that we continue to satisfy best decks for our customers.
I'm glad you mentioned protecting market makers. That's a constant refrain of mine here on the network. And this is your first time on, so I haven't had a chance to pick your brain on this topic yet. Usually we do this at all of our OIC roundtables and all those fun sessions there. But I'm curious, as you mentioned, there are a small handful of liquidity providers left in the space, and it seems like that number is contracting all the time. Not a lot of growth going on that side of the fence. So I'm curious, now that you're on the exchange side, what do you think we as an options industry can do to maybe reverse that trend, to maybe incentivize more firms to go out there and take the risk of becoming a liquidity provider in 2019?
Yeah, no, I think you're raising and thinking about it the right way. I think there's two things that I think are interesting to talk about. One, we are seeing a little bit of growth of not only new entrants and new entrants in what I would consider the arena of maybe in the equity space or the future space, that they have gotten sophisticated technology tools that we're starting to see them deploy in small fashions into the option space. Something that's maybe been talked about but not necessarily seen. And this year we've seen it, whether that's someone acquiring another trading or an options trading team, or it's starting to see select, maybe they're very good in ETFs or select equity underliers, and it allows them to actually then exploit and provide liquidity in options in those similar types of small names that they might be able to tip their toes into options. But how do we make sure that they're being able to stay and maintain that presence is something that we have to be concerned with as an industry in general. I think that this leads to some of the overarching concerns in the industry, which I know that you probably have talked about on your show in past, is with regards to capital requirements and some of the constraints that are primarily affecting a lot of the liquidity providers. And if we're able to work aggressively, Cboe has been a proponent for many, many years with the OCC as well as even the regulators, SEC and CFTC, to allow for maybe if it's portfolio margining and improvements for the institution. Are we also looking at risk-weighted assets a lot differently? How can we also talk about the current exposure method and its evolution into SACR? Does that allow and alleviate some of the pressures associated with the capital requirements that might be limiting some of the entrants and then also limiting the existing liquidity providers because of the limitations in capital that they can deploy to the street and liquidity concerns that might come to it? I do think that we're in the precipice and maybe just about to see some of the changes that might happen with these regulatory changes. So I do believe this is a great point that maybe as we go into 2020 and even into 21 that we're going to see a pretty significant change that would maybe allow for existing liquidity providers to provide more, as well as maybe new entrants to enter the marketplace or even in larger size.
I'd imagine the capital requirements will probably be a very popular topic at a conference like this here this week as well. So I don't think we've heard the last of that issue. Obviously, we're here at the STA conference. Last year when I was doing these hits, crypto was top of mind for a lot of people here. In fact, I have to say, for an equities conference, a surprisingly large percentage, over half of our guests last year, were somehow in the crypto realm. Obviously, it's top of mind again. There's been a lot of movement out there over the past week. Cboe, obviously, prior to your tenure, exited the crypto space, but obviously a lot of questions about that. I'm curious for you, what are your thoughts on the crypto space, how that all unfolded? I had the Gemini folks on not too long ago, and they said, hey, ask the Cboe about all that. So I'm asking you now about how all that unfolded in your view, and maybe are there any plans to revisit that space down the road?
I think that a lot of that evolved prior to my joining, and I think that it continues to be an interesting space nonetheless. There is obviously you read that there's a lot of headlines, that there is excitement, there's growth, and everyone wants to be associated or making sure that we're understanding the market structure as well as the evolution of that marketplace. I do think that is one that we continue to be interested in and will monitor as such. I think that, I don't think that, Cboe is, out of the space at this point. I think we will continue to monitor and how we think thoughtfully about maybe maintaining a presence within that entire arena, whether that's in the capacity of a future or options or any volatility type of instrument, because that kind of is our bread and butter. And as we think thoughtfully about new product and new product development, that's definitely always going to be something in addition to looking at credit volatility or rate volatility. It's always going to be in our bread and butter to think about that asset class as well, because we can't ignore what we've seen in terms of growth and ebbs and flow in initial growth of a new product. So,
speaking of new products, or maybe a bit of an old product making a comeback, we do a show every week with the FTSE Russell folks, and there's been a lot of talk lately on that program about the potential for bringing back one of my old favorites. Unfortunately, it didn't get a lot of broad traction, but maybe those days are changing. Of course, RVX I'm speaking of, which is the old Russell 2000 VIX. And we were big fans of it. We talked about it a lot. I think we're one of the only ones, but I think that's changing now given what's going on in the Russell 2000 landscape. Seems like there's a little bit more interest in, shall we say, that micro cap, small cap type name. Any interest over there in maybe revisiting that asset class, that small cap volatility space?
Yeah, no, I think you're going through a lot of the product queue I have right now in terms of
the greatest hits. That's why I'm here.
I think there's two things that need to happen there, and I think that we're really thinking a lot about the evolution and the distribution effort of that product. So you look at Russell and you look at it in comp to not only IWM, and you also look at it into comp as it pertains to the correlation to SPX and how interested are asset managers, even retail customers in particular, utilizing that as a hedge versus maybe using the S or SPX to hedge their portfolio. Is that still an interesting product, or is people still uniquely positioned to think thoughtfully about the small cap space in this environment where you're seeing markets trend towards very large macro events and indicators that they tend to go back to maybe SPX and SPYs rather than maybe some of the small cap allocation of capital. That being said, we are spending a lot of time with those end users right now to understand their thoughts on and distribution of allocation of capital to them in that asset class, because we do want to continue to see the growth of that. And I think that there's been some unique shifts in market structure that maybe has limited the exposure, but we do believe that we will continue to see growth. We've seen a lot of growth on Russell as it pertains to the retail community. We still want to continue to see that growth on the institutional side versus IWM. So one that we are actually having a distribution and a sales campaign right now alongside of our colleagues at FTSE Russell to make sure that we're really pounding the pavement and making sure that we're talking to the end user as much as possible. I think that leads itself back into your question about, once you have the demand in the traditional index product on the option side, then you can think thoughtfully about maybe exposing or allowing people to think about implied vols or the VIX component of Russell. Until you have that, I think you need that demand on the institutional and retail side and the traditional options product, then you probably make a step back into the VIX component of Russell.
So maybe not quite there yet, but maybe percolating, maybe on the way sometime, hopefully.
We won't turn our head to any VIX product. We can put VIX on anything.
Well, Arianne, I'm glad we can get you here on the program. And before we wrap up, maybe we had a long, kind of far-reaching conversation. Maybe you said, you know what, we forgot to mention that. Or maybe you want to leave our audience a little bit of a hint, a little bit of a tease of what's coming down the pike from Cboe. Now is the time, ma'am. The floor is yours.
I think what you'll continue to see is an evolution of the vision of Cboe as it pertains to our distribution and our product suite. We will continue to think outside the box in areas that are growing, not only within the credit space or within the rate space, where we think you're going to see us evolve into rates being exciting as we head into the election year next year. We do think that is an interesting area to see increased amount of exposure and concentration of risk, meaning that we do have a product that is a 10-year VIX, 10-year Treasury rate VIX. The ability for us to exploit maybe the entire curve, a 2-year, a 5-year, a 10-year, a 30-year, to start to do calendars or kind of term structure types of trades are going to be something that I think is really relevant, and we're hearing and seeing a lot of demand out there. The ability for us to look at our future suite, and one maybe missing component of it is an options on futures. So the ability for us to not only be in the future space and the cash equity listed option space, it's a natural for us to think thoughtfully about options on futures. So if we think about some of those things, we have a lot of things to conquer, not only in our existing products, but we're definitely thinking about areas where we maybe aren't invested yet to also evolve into new areas that we can distribute the Cboe name and the Cboe product.
Arianne, I'm glad we can get you on the program. I look forward to seeing how all these various initiatives, how they unfold in the marketplace in the coming months.
Cool. Thank you very much for your time.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. The Options Insider Radio Network is sponsored by Fidelity Investments. Fidelity's Option Trade Builder tool can help you confidently build an options trade in 3 simple steps. Just choose a strategy, select a contract, and then review the benefits and risks of the trade. Learn more about Option Trade Builder at fidelity.com/options. Options trading entails significant risk and is not appropriate for all investors. Certain complex option strategies carry additional risk. Before trading options, contact Fidelity Investments by calling 800-544-5115 to receive a copy of the characteristics and risks of standardized options. Fidelity Brokerage Services, LLC, member NYSE SIPC.